Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to co-CEO Frank Hanna and CFO Ryan Mahoney of Michelmersh Brick, a leading and premium UK brick manufacturer. So welcome, gents.
Morning, Paul. How are you?
Very good, yeah. Well, big congrats on today's excellent results. So I suppose, Frank, you could kick off in just sort of broad terms, talking about the state of the UK brick market, because we've seen all things sort of like building products related and house builders. The share prices have come off, but everybody sort of en masse is still talking about sort of like full order books and strong forward demand and coming off the back of some pretty good results. So can you just help us? What has the market got it wrong? Or, I mean, what is the state on the ground of the sort of like the house building and repair and maintenance industries?
Well, I think in answer to your question, there's two issues. I think firstly, the whole equities market has come off because of the Ukraine thing. That's fairly evident and obvious. But secondly, against that backdrop, if you look at UK construction, we've still got relatively historically low interest rates. I think people are a lot more focused on home ownership. I think we are not building enough houses to meet the demand. So fundamentals are there. And I think during the lockdown period, we saw an increase in our RMI, as people were in essence nesting, if you like. So if you take us, our forward order book is pretty good, and I think our focus for H1 of this year is to convert that forward order book into sort of positive results. In terms of brick supply, if you like, we're making around 1.95 billion bricks in total in the UK from about 49 plants. And then the rest of the demand is being soaked up or met by some of the products that are coming in from the Benelux regions. And as you know, we've got a plant in Belgium. And to a certain extent, there's a similar level of comparative to the Benelux region as well. That's, the same dynamics over there as there are here.
So just in terms of the sort of the Ukraine, we say we couldn't make this one up, could we really? We've come off 2 years of pandemic and we've just got through that. So everybody's been triple boosted and vaccinated. So that seems to be sort of like relatively now turning from a pandemic to an endemic. But now we've got the Ukraine, Russia. Has that seen any impact at all on the UK housing market with Ukraine, Russia, other than just sentiment and news flow?
I think it's too early to say. I think if anything affects the UK housing market, being honest, it will be global financial pressures, and I don't think anybody really knows where this is going. That's my view. But, I come back to the point that we still have very strong sector fundamentals, and relatively speaking, when you look at it from a historic perspective, interest rates are low.
Well, and also, you've mentioned about sort of, the premiumisation, people nesting and wanting to make sure that the houses look good. I mean, I had a sort of data point where a friend of the family sold their property just recently in 2 days, and they had 27 people look at the houses, and they got a price higher than their asking price. So there's still far more people sort of seeking existing properties and new properties over and above. So how in this Q1? I mean, obviously you've come off some really strong 2021 results, even better actually than pre-pandemic levels. So big congrats there. But how is the business faring now in Q1? Do you want to take that one actually, Ryan? Just in the sort of top level, sort of trading.
Yeah, no, our trading has continued very well, and we've said that in the statement that we're very pleased with how the first quarter has gone. As Frank said, I think it's too early to call. We're still foreseeing positive sentiment across our key sectors. And we're not seeing any signs as yet of that changing. So, no, our key distributors, our customer base, we're very pleased with how the year has started.
And Frank, have you got enough bricks? I mean, the last 2 years you've been fighting to try and get as many bricks as possible.
We could do with a little bit more stock, being honest. But, our model is always to run all of our plants at 100% output.
Yeah.
And then we set our sales parameters around that. But we could do with a little bit more stock, to be honest with you. It just makes you a bit more fleet of foot for just-in-time deliveries. But we've got a really good team that work around the order books, look at what's required when, and are very good at scheduling product. So in essence, we make sure that we fulfill and meet all our customers' requirements, as much as we possibly can.
Well, I remember you. That was a perfect example of that. Was about sort of like, was it 4 or 5 weeks after the initial lockdown in March 2020? You and your management team had the foresight to get your workforce back before anybody else really across the country, because you started up your factories as soon as you could, didn't you? I remember that, and that was a great decision because it gave you a bit more bandwidth to build some stock.
Absolutely. I think the team at the time worked incredibly hard, particularly our health and safety teams, to reconfigure our processes and our plants to make sure we were COVID secure. And we were able to sort of reap the rewards of that. Yes, it impacted the 2020 numbers, which was a bit galling, but in reality, we only lost 3 weeks to a month in terms of total production output. Could have done with that through 2021. However, I think we fared pretty well given the circumstances. And I think it's worth noting at the moment, those processes that have been put in place are still relevant today, and as you know, we had the Omicron variant early in the year and tail end of last year, and that didn't affect us because we already had the processes in place of how to deal with it.
And likewise, Ryan, I mean, I think you've picked up Frank's sort of foresight capabilities or crystal ball, because I remember in a trading update back in November, you talked about sort of forward booking your energy, sort of like and that was before the Ukraine-Russia crisis. So you did well so you obviously got a hotline into Putin, haven't you? Somehow you saw that one. Can you just talk through how you're managing that and and the sort of protection that gives you going forward for 2022 and 2023?
Yeah, thank you, Paul. I wish it was a crystal ball, to be honest. No, I mean, we take a very risk-based approach to how we manage our energy costs. As you know, it's a very significant part of our sort of cost of production. We, generally speaking, we look to have the vast majority, substantial amounts of our energy requirements fully hedged, essentially, for 12 months looking outwards. And then beyond there, we try and put positions in place across the next few trading years thereafter, again, to try and risk manage what we see as a sort of a potential for energy volatility. And that's very much the approach we've taken. We take that risk-based approach. We put those 12 months in place, and we've got that cover out to the end of winter, which is out to March 2023. And we see that as a very important approach for us so that we can manage what has been unique volatility. And I use that word unique. Before August 2021, we really had quite a benign energy market. And subsequent to that, Norway situation caused the summer spike last year, and clearly none of us predicted Vladimir Putin would move into Ukraine. So these are all things we couldn't predict. But again, from our approach, we try and risk manage. And whilst we can't predict individual events, we think it's the right way to try and manage our cost base.
And Frank, just turning now to sort of the selling prices, how are you sort of managing the sort of input cost inflation through your sort of like your revenues, and well, obviously your selling prices, because many in the industry like Travis Perkins have been putting up their prices like 3 times last year.
Yeah, we try and take a more measured approach in that we work with our end users and our customers. We look at the volumes they're taking. We look at their forward orders and what they've got. We don't want to give them any surprises, so we like to try and be as balanced as possible. So taking Ryan's point earlier about the energy, if we see energy that's on budget or under budget, going out, say 23, 24, we'll buy it, and that de-risks. So we'll talk to the distribution base, and we'll look at things such as energy, haulage, all the other key components that have an impact on price. And we will try and put through measured increases on specific products, generally on six monthly increments. Where possible, we like to try and give price stability for a full year. But I think the important thing is that we try and protect the margin of the business as well, because obviously it's a capex hungry business. We need margin to reinvest. So it's important that we don't erode that. But in the main, our distribution and our customer base has been pretty supportive and have, as much as they can be, they work with us through the process. So I think there's a fundamental need to have a strong relationship with your distribution base and also your end user customer base, so that you can talk through the dynamics and implications of price increases, if you like.
And bricks, I mean, people think that bricks actually are expensive, but in the grand scale of things, when it comes to sort of building a house, it's the labour, isn't it?
Yeah,
the labour and the other parts.
If you look at the average invoice value for 12,000 bricks for a 3-bedroom semi-detached house, you're looking at £5,000. It's de minimis when one compares it to windows and kitchens, as an example.
Yeah.
So yes, bricks have gone up within the sector, but they are still a very small part of the total overall cost when you consider that they make up the biggest proportion of the superstructure, if you like.
Yeah, I mean, if you fully carpet a house, I mean, it's 20 grand, isn't it? Or 15, 20, something like that anyway. Yeah. So Ryan, just in terms of sort of managing that cost selling price dynamic, I saw you've managed to retain your sort of gross margins largely flat year on year, which was great last year. It was a really good rate. What are you sort of expecting this year? Should investors sort of like look at that? Because I think you hit sort of you about 41%, I think, for the last couple of years.
Yeah, that's right, Paul. 41%, and again that dropped through to EBITDA margin as well, just shy of 25%. I think we remain watchful. I think all the conversations that we've had and some of the sort of the feedback we've given you, we are still in very unprecedented macroeconomic times. And whilst we as a management team, we do take steps to make sure we try and mitigate and manage our cost base, there are still areas of volatility which we are watchful of. The utilities, whilst we substantially hedge, we always deliberately leave a portion based on pure sort of variance in weather. We don't want to be over hedged through our utilities, and as Frank said, haulage and labour are two other costs which it's well publicised. There's still volatility out there. Inflation is still running. What we expect to probably top out near double digit. So all of that means that we remain watchful of those margins, both across the gross profit and our EBITDA. So I think it's important that whilst we see that medium-term target at or around that 25%, it's important investors do recognise some of those outward challenges.
Now, Frank, just turning to another potential growth driver, we've mentioned obviously new build housing and repair and maintenance, etc. Can you just talk through the sort of like cladding opportunity here? Because obviously the government's sort of forcing the house builders to put in about £4 billion at least across the UK. And obviously there's lots and lots of other buildings now who want to look good and then won't be able to put the new cladding they put in will have to be sort of like 100% fire resistant. So how is Michelmersh positioned to at least sort of get some of that opportunity?
We've always got that on the drawing board, to be honest with you, Paul. Historically, we've always, because of our manufacturing processes and the products that we make, some of them are very well suited to cladding applications. We make products that are capable of going into a multitude of cladding systems. So we're not tied to any one specific cladding system per se. But I think this drive for an A1 rating above 18 metres is no doubt going to help the brick industry as a whole. Because fundamentally, it's proven time and time again in terms of its fire resistance, its thermal capability, its frost resistance, and all the other things that come with it. So I think there is opportunity. We've got a number of schemes on the board at the moment which we're supplying or about to supply, but that's normal within the course of our sort of monthly business, if you like. They tend to be very specification driven and specification led. So we have a specification team that talk to designers and architects about these sort of things.
Okay, well, we'll hopefully pick that up in future interviews. Now, Ryan, you've managed to squirrel away 7.7 million pounds of net cash, which is extra 7 million on last year as well. So what are you planning to? What are the sort of the investment sort of themes that investors should look at? I mean, obviously, we may need a bit more capacity if we possibly get M&A. I don't know. Where else are you looking at?
Yeah, that's a good point, Paul, and that's the real benefit of our working capital cycle and the operational cash generation of the business. So just pausing, that's the third year in a row we've generated above 100% of adjusted EBITDA to operational cash. That's a very strong metric for us. Three things, really, three priorities for us with our cash. Number one is our progressive dividend policy. We believe on a sort of balanced return to our shareholders. We think that's a really important part of rewarding our shareholders and our long-term holders especially. Number two is continuing to invest in our facilities. Maintaining well invested and efficient facilities is key to our success. And number three is, we are actively looking for acquisition opportunities to meet both commercial and financial criteria for us. So that's really the way to think about that sort of growing cash position for us, is that we'd look to maintain those three pillars of investment strategy.
Well, I'm guessing with the downturn in all things building products related and the whole sector coming down, you've got there's a few opportunities with the valuations now are a bit more attractive than they were 12 months ago, I guess. Now, Frank, just in terms of let's just hypothetically say, looking at the sort of the new build house market, if house prices started to cool in terms of rising mortgage rates, how would that sort of like hypothetically blow through on Michelmersh Brick in terms of, what other sort of areas would it then, sort of like lean more towards?
I think in fairness, if the housing market cools somewhat or slightly, as it's done in the past, we do have a very balanced order book, so we're not wedded to one particular sector. And we say this all the time, it's about not having too much risk in one particular area. And we're quite good at moving our focus into other parts of the marketplace. And, for example, we did that before when, do you remember the stamp duty
Yes.
went up for the high-end homes? And we immediately had a meeting with the sales directors, and at the time we could immediately start to see those jobs start to come back, in terms of being pulled from the drawing board. So we were able to sort of shift into other parts of the marketplace. And I think that what's different this time, if you look at the whole housing market, the brick capacity for the UK isn't sufficient really in reality to supply the whole marketplace, and we've got that European import underpinning that position. So I think that's quite a strong dynamic to look at in the context, and that's what makes it slightly different this time to prior to the previous recession.
So we've got almost like a government put, haven't we, underneath the UK housing market, who are saying they want sort of 300,000 properties built every single year. They're only doing about sort of 200, which means, Frank, you've got to get on your bike here. You've got to generate another at least 50% greater production in the next few years.
And I think if you look at it in that context, even if you drop the housing numbers back to 175, 180, broadly, the UK brick sector is still relatively busy.
Yeah. And I'll just highlight to investors, just looking at sort of valuation. I mean, I think the Michelmersh shares are around about sort of like 112p at the moment, trading at sort of 6.6 times forward EBITDA. I mean, the whole market's come down, and I would personally value the business at sort of 10 to 11 times sort of EBITDA, which would be, absolutely in line with the specialist premium sort of brick manufacturer. And that gets out at around about 145 to 165 pence per share, which actually, just by chance, is not too far off from where I think Canaccord are about 160. So it shows the upside for investors. Now, Frank, just finally then to finish, the news flow going forward. Then you've obviously got your AGM presumably at some point in time, or is it just go straight into your into a sort of like a Q3 or Q2 trading update?
No, we'll have the AGM and we'll do a trading update prior to the AGM. So we're just finalising the date on the AGM now, actually, aren't we, Ryan? We were just looking at some of the
May the
bank
12th,
holiday. May the 12th, is it? Yeah.
May the 12th, right? Okay,
Yeah.
great.
It's come back forward again, Paul. We've got the Queen's Jubilee to look forward to this year, so we brought it back into where we had it in 2019, pre-COVID. So no, we're looking forward to it.
Okay, great. All right, well, big congrats, as I say, on the results, and it looks a positive outlook. So, yeah, hey, well, let's see where the market's got everything, the whole sector totally wrong, because I certainly believe it has, and I'm still invested in the property and repair and maintenance and market. So, well done, gents, anyway, and speak to you again going forward.
Thanks, Paul.
Thanks, Paul.